Today we are breaking down a fresh take from Dan Ives on CNBC's Closing Bell, where he explains why he believes tech investors are underestimating what is coming next, and what Nvidia CEO Jensen Huang could signal for the next phase of the AI trade. I'm going to play the clip first, then I will give you my reaction and break down the key points in plain English. After that, I will share my in-depth analysis of 4 top tech stocks to buy right now based on where I see the biggest opportunities forming. If you get value from this, hit the like button, subscribe, and drop a comment with your take on tech in 2026. Now let's hear what Dan Ives has to say.
Nvidia CEO Jensen Huang takes the stage at CES for his closely watched keynote address. Wedbush's Dan Ives joins us now with what we might hear. It's good to see you. You are there, as one would expect you to be. What's he going to say today?
Look, I mean, there's only one godfather of AI, right? And it's Jensen. I think he's going to lay out specifically around robotics, autonomous. Look, this is the next chapter of AI that I think Jensen's going to talk about. And obviously, I think he's also going to hit on just the demand that he's seeing, and no one has a better vantage point. And Scott, I think really what it does, this kicks off the next sort of layer of the AI revolution when it comes to robotics, autonomous. And I think that's something that is not factored into Nvidia stock, and I don't think it's factored in to a lot of these other tech names, Qualcomm among others.
So he's ready to move on, you think, to AI 2.0, if you will, where we move past all of the talk specifically about that company's chips and about how they can better be utilized in the areas that you're talking about?
Yeah, I think this is really him planting the flag, showing that Nvidia, it's not just about chips, the 12-to-1 demand that we see, and obviously fueling the AI revolution. It's showing that they're going to be end-to-end when it comes to robotics. They're going to be such a huge player when it comes to autonomous. And like we've talked about, like for Tesla, this is the year of autonomous. It's the year of robotics. And I think it all starts with Jensen because no one has a better vantage point. And I think what he lays out here is really going to dictate strategically what we see on the consumer AI revolution that hasn't even started yet.
Now, why has the stock been a sideways trader of late if everything is so bullish from even here forward?
Yeah, I think to some extent, I think it's investors thinking that, numbers will beat the street, but not by a lot. What's the excitement? Has it all sort of been in the rearview mirror? Scott, I think this is $250 stock. Like, to me, the demand and what they're going to show in their next quarter, we talk about 12-to-1 demand to supply. When you think about the autonomous and robotics revolution, what that's going to mean to Nvidia, I think that alone is going to add $40 to $50 a share. And I think this is one where investors, they're kind of yawning at what Nvidia stock's doing right here. And I think we sit here 6-9 months from now, I think it's a table pounder opportunity to own Nvidia, to own Microsoft, to obviously to own names like Oracle as well.
Well, hold on one second, because I'll get to some of these other names, but you raise an interesting question, or maybe a problem in some respects. How high is the bar now? And is the bar now viewed to be increasingly high, arguably to the point where they can't meet whatever expectations we now have for this company, and that ultimately is going to cause some sort of correction even further in the stock?
Yeah, it's a great point. I think at 225, 230, maybe I'd say that. Here, I actually disagree. I think investors are underestimating what the demand's going to look like for Nvidia in terms of next year. I think street numbers are underestimated by 15, 20%. Next 12 to 18 months. And I think it's the ripple effect. For every dollar spent on a NVIDIA chip, there's an $8 to $10 multiplier across the rest of tech. That's why we've said, it's top of the third inning in a 9-inning game, 1 out, in terms of where we say. That's why this tech bull market's going to continue to play out. It all starts with the godfather right now.
The first thing Dan does is frame Jensen as the central figure in the AI story. That is not just hype for TV. It is a way of saying, if you want to understand where enterprise spending is going, where the next product cycles are forming, and which themes could pull in the next wave of investors, you listen to Nvidia because they are sitting at the choke point of AI infrastructure. When Dan calls him the godfather of AI, he is basically telling you that Jensen is not showing up to talk about a single chip launch. He is showing up to define the next chapter of the entire narrative. And that next chapter is the core of Dan's message: robotics and autonomous systems. Notice the pivot. For most of the last 2 years, The mainstream AI conversation has been dominated by data centers, GPUs, training, inference, hyperscalers, and the mad rush to build capacity. Dan is saying the market has heavily priced that in, but the market has not fully priced in what happens when AI leaves the data center and starts living in machines that move, see, react, and operate in the real world. When he says robotics and autonomous, you should hear physical AI, not just chatbots, not just co-pilots, not just text and images. He means AI embedded in cars, warehouses, factories, humanoid robots, logistics systems, and edge devices that have to make decisions in milliseconds with real consequences. If that becomes the next spend cycle, Nvidia is not simply selling more chips. Nvidia is trying to be the platform layer that powers the whole stack, from training models to simulating environments to deploying models into physical devices. That is why Dan uses the phrase, planting the flag. He is telling you Jensen's keynote is likely to be a positioning statement. Nvidia wants investors to stop thinking about them as a one-product story and start thinking about them as an end-to-end company. End-to-end in this context means the hardware, the networking, the software frameworks, the developer ecosystem, and the tools that let companies build autonomous systems at scale. Now, let's talk about that AI 2.0 idea that comes up in the questions. The host is basically asking, are we moving past the chip obsession and into applications? Dan's answer is yes, but in a very specific way. He is not saying chips stop mattering. He is saying the next leg is about where chips go next and what they enable. In other words, the chips are still the engine, but the story becomes the car, the factory, the robot, the consumer device, the whole product experience. That line about consumer AI revolution that hasn't even started yet is important. Dan is implying that we are still early in the mainstream rollout of AI into everyday consumer life in a way that truly changes behavior, spending, and product categories. Right now, a lot of consumer AI still feels like features added to existing products. Dan is anticipating a shift where AI becomes the product, or at least becomes the central reason people upgrade devices, subscribe to services, or adopt new platforms. He also connects this to other names beyond Nvidia. He throws out Qualcomm, Tesla, Microsoft, Oracle. That is not random. He is describing a chain reaction. Qualcomm represents the on-device and edge compute angle, especially as AI features move onto phones, PCs, and embedded hardware. Tesla represents autonomy as a consumer-facing and real-world AI showcase. Microsoft represents the platform distribution of AI across enterprise software. Oracle represents data center infrastructure, databases, and cloud demand that can rise with AI workloads. Dan is basically building a map where Nvidia is the ignition point, but the combustion spreads across the whole tech ecosystem. Then, we get to the part that retail investors always care about. If this is so bullish, why is the stock trading sideways? This is where Dan is trying to diagnose sentiment. He is saying the market thinks Nvidia will beat expectations, but not by enough to create a fresh shock to the upside. In plain language, he is saying investors are acting like the easy money has been made, and the story is in the rearview mirror. That is exactly what happens when a stock becomes the poster child of a theme. The bar rises, good news becomes expected, great results become fine. And the stock can stall even while the business is strong because expectations are doing damage. Dan's rebuttal is basically, you are underestimating demand, and you are underestimating the new demand categories that are about to open up. He brings up 12-to-1 demand supply. Whether you take that literally or you take it as a rhetorical way of saying demand is massively outstripping supply, the point is the same. He is emphasizing scarcity and backlog. He is saying customers want more compute than the market can currently deliver. That matters because scarcity supports pricing power, supports visibility, and supports continued capex spending by customers trying to secure capacity. Then he goes further and makes the bold stock call, saying this is a $250 stock, and that autonomy and robotics alone could add $40 to $50 a share. Here is how I interpret that. Dan is not doing a precise discounted cash flow on live television. He is telling you that the market is not assigning enough option value to new growth vectors. Option value is what investors pay for when a company has credible paths to expand into adjacent markets that are massive. Robotics and autonomous is a massive adjacent market. If Nvidia can be a foundational platform in that world, then the total addressable market expands, the duration of growth extends, and the multiple can stay elevated longer than skeptics expect. But I also want to translate the risk embedded in this statement. When you say this alone adds $40 to $50, you are implicitly saying the market will accept that narrative, assign value to it, and not punish the stock for execution risk. Robotics and autonomy are real, but they are also messy. Timelines slip, regulation and safety concerns show up. Hardware cycles take longer, and sometimes the use cases look amazing in demos but take time to become profitable at scale. So Dan is very bullish, but the market will demand proof, not just vision. Now the host asks the toughest question in the whole clip: how high is the bar, and can Nvidia actually meet the expectations investors now have? That is the right question, because at a certain point, it is not about whether Nvidia is a great company, it is about whether Nvidia can exceed the fantasy that investors have already baked into the price. The host is basically warning about a scenario where expectations become impossible, and even strong results cause a sell-off because they are not strong enough. Dan's response is interesting because he says he disagrees, and he gives two arguments. First, he claims the street is underestimating the next 12 to 18 months by 15 to 20%. Translate that: he believes analysts' revenue and earnings forecasts are too low. That is a big statement because if it is true, then the bar is not actually as high as it feels. If forecasts are still too conservative, then Nvidia can clear the bar with room to spare, and the stock has room to re-rate higher. Second, he brings up the ripple effect and says for every dollar spent on an Nvidia chip, there's an $8 to $10 multiplier across the rest of tech. This is one of those lines that sounds like a soundbite, but the concept is real. Nvidia chips are not bought in isolation. When a company buys AI compute, they also spend on networking, storage, data center buildouts, power, cooling, software, cloud services, security, integration, and the labor to deploy all of it. So Dan is describing an ecosystem spend cycle. Nvidia is the tip of the spear, but the spending expands into multiple categories. That is why he keeps bringing up Microsoft and Oracle. He is pointing to the second-order beneficiaries of the AI capex wave. And that is where I want to add my own perspective. The multiplier idea helps explain why the AI theme has lifted so many stocks, but it also explains why the market can get fragile. If the Nvidia-driven capex cycle slows, even temporarily, the market can start repricing a whole basket of AI beneficiaries at the same time. So when Dan is bullish, he is bullish on a chain reaction. But the flip side is, any disruption can also ripple. So what do I think Dan is really telling you to watch coming out of Jensen's keynote? I think there are three big things. One, does Jensen clearly articulate an end-to-end robotics and autonomy platform? And does he give developers and enterprises a reason to believe Nvidia can own that stack the way it has owned core AI compute? The market loves coherent platforms because platforms create switching costs. If the keynote makes it feel like Nvidia is building the operating system and tool chain for physical AI, that is what can extend the narrative beyond just GPUs. 2. Does he give signals about demand visibility that calm the market's fear that growth is peaking? Dan is leaning on the idea that demand still overwhelms supply. If Jensen reinforces that with confident language about pipeline, adoption, and product roadmap, that can shift sentiment from "the best days are behind us" to "this cycle is longer than people think." 3. Does he connect the dots to consumer AI in a way that feels imminent, not theoretical? Dan says consumer AI hasn't even started. If Jensen shows real pathways for AI to move into devices and everyday products at scale, that expands the investor imagination. Markets trade on imagination in the short run, then they trade on numbers. A keynote is about imagination, but it can set up the numbers later. Now, let me be very clear, because reaction videos should not just repeat the bull case. Nvidia can be an incredible business and still be a volatile stock. Sideways action is not a sign the company is failing. It is often a sign the stock is digesting a massive move, waiting for the next catalyst, and forcing the company to prove it again. That is the cost of being the leader. You do not get rewarded for being great. You get rewarded for being even greater than the market already assumed. Dan's table pounder language is basically him saying, this is the moment to lean in before the next narrative shift gets priced. I respect the conviction, and I also think the market is going to demand evidence. The robotics and autonomy story has enormous upside, but it has to move from keynote vision to revenue line items over time. The market can price the option value today, but it will eventually ask for the receipts. And the last thing I want to point out is that the transcript cuts off right when Dan is starting to broaden the point about the ripple effect across tech. Even in what we have, the direction is clear. He is making the case that Nvidia is not an isolated trade. It is the engine of a broader AI economy. And if Jensen successfully frames the next chapter as physical AI, robotics, and autonomy, then the beneficiaries expand well beyond Nvidia itself. So my overall takeaway after watching this is simple. Dan is telling you the market is too focused on what Nvidia has already done, and not focused enough on where Nvidia is trying to take the AI story next. If Jensen executes the messaging and the roadmap looks credible, sideways can turn into the next leg up. But if expectations remain sky high and the keynote feels incremental, the stock can still chop around even while the long-term thesis stays intact. And that is the real game here. In the short term, the market trades the keynote. In the long term, it trades the adoption curve. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 4 top tech stocks to buy now. First up is Broadcom, ticker AVGO, a company powering the backbone of our digital lives. Broadcom's chips are in everything from iPhones to massive data centers, making them essential to global connectivity. Their business is split between high-performance semiconductors and enterprise software, creating both growth and stability. The VMware acquisition positions Broadcom as a major player in hybrid cloud, expanding their reach into enterprise IT. Financially, Broadcom is a cash machine, efficient, profitable, and committed to growing dividends for shareholders. Their diversified model reduces risk with exposure to 5G, cloud, and the Internet of Things. Risks include semiconductor cycles and reliance on key customers, but their broad footprint offers resilience. Broadcom's leadership in critical tech sectors, strong management, and focus on shareholder returns make it a cornerstone holding. It's a quiet giant, essential, innovative, and built for the long haul. Every serious tech investor should have Broadcom on their radar. Next up is Meta Platforms, ticker symbol Meta, a company that has evolved far beyond its origins as just Facebook. While many still associate Meta with the blue Facebook app, the reality is that this tech giant has transformed itself into a multifaceted powerhouse, shaping the way billions of people connect, communicate, and interact online. Meta's story is one of relentless innovation, bold pivots, and a willingness to bet big on the future of technology. Today, Meta's ecosystem spans nearly 4 billion users across its core platforms: Facebook, Instagram, WhatsApp, and Messenger. This reach is simply staggering. Almost half the world's population interacts with a Meta product every month. Whether it's sharing life updates, connecting with friends and family, discovering new trends, or building communities, Meta's apps have become deeply woven into the fabric of daily life for people across continents, cultures, and age groups. This massive user base gives Meta an unparalleled advantage in digital advertising. Their ad business is a cash printing machine, generating tens of billions in revenue each quarter. From global brands to local businesses, advertisers flock to Meta's platforms for their unmatched targeting capabilities and scale. But the real story isn't just about ads. Meta is also making a bold, high-stakes bet on the future, one that could redefine how we experience the internet itself. Enter the metaverse and spatial computing. Meta leads the consumer virtual reality market with its Quest headsets, bringing immersive experiences to millions of users. From gaming and fitness to education and remote work, the Quest platform is laying the groundwork for a new era of digital interaction, one where physical and virtual worlds blend seamlessly. Meta's vision is ambitious: to build the next generation of the internet, where presence, connection, and creativity are limited only by imagination. Of course, such bold bets require massive investment. Meta's Reality Labs division, which drives its metaverse ambitions, has poured billions into research and development. This has drawn scrutiny from investors, especially during periods of market uncertainty. But in 2023, CEO Mark Zuckerberg declared a year of efficiency, streamlining operations, cutting costs, and refocusing the company on core priorities. The result? Restored profitability, renewed investor confidence, and a leaner, more agile Meta ready to tackle the future. But Meta isn't just about social media and virtual reality. The company is also making waves in artificial intelligence. Their open-source AI model, Llama, has quickly become a major force in the AI world. By making Llama available to developers everywhere, Meta is accelerating innovation and democratizing access to cutting-edge AI tools. This move positions Meta as a key player in the rapidly evolving AI landscape, with the potential to shape everything from content moderation to new consumer experiences. Today, Meta stands on 3 powerful pillars: a dominant social media empire, a high-risk but potentially transformative metaverse bet, and a rapidly advancing AI initiative. Each pillar supports the others, creating a diversified business model that's both resilient and full of upside. This unique combination gives Meta the flexibility to adapt, experiment, and lead in multiple arenas at once. Of course, challenges remain. Meta faces intense regulatory scrutiny around the world, from privacy concerns to antitrust investigations. Competition is fierce, with rivals like TikTok, Apple, and Google constantly innovating. Yet Meta's robust cash flow and its recent decision to pay a dividend for the first time ever signal a new era of strength and maturity. The company is showing it can balance growth, innovation, and shareholder returns, even in a complex, fast-changing environment. For long-term investors, Meta offers a compelling proposition. Its core social media business remains a stable, cash-generating engine. Meanwhile, the company's bold moves into the metaverse and AI provide exposure to two of the most important technology trends of the next decade. This combination of stability and upside potential is rare, and it's what makes Meta such an intriguing opportunity for those willing to look beyond the headlines. In many ways, Meta is an asymmetric bet with huge potential. The risks are real, but so are the rewards. For those who believe in the power of technology to reshape how we live, work, and connect, Meta Platforms stands at the crossroads of the digital future, offering not just a window into what's next, but a chance to be part of building it. Our third company is Taiwan Semiconductor Manufacturing Company, better known as TSMC. While the name might not be as familiar as Apple or Google, TSMC is arguably the most important company in the world that most people have never heard of. Based in Hsinchu, Taiwan, TSMC is the silent giant behind the digital revolution, quietly powering the devices and technologies that shape our daily lives. TSMC manufactures the advanced semiconductor chips that are the brains behind everything from your smartphone and laptop to the servers running artificial intelligence and the computers in your car. In fact, TSMC is responsible for producing over 60% of the world's semiconductor chips made by foundries, and an astonishing 90% of the most advanced, leading-edge chips. These are the chips that power the latest iPhones, cutting-edge AI data centers, and the most sophisticated electronics on the planet. The world's biggest and most innovative tech companies, Apple, Nvidia, AMD, Qualcomm, and many more, rely on TSMC's unmatched technological expertise. TSMC's manufacturing processes are years ahead of most competitors, allowing it to produce chips that are smaller, faster, and more energy efficient than anyone else. This technological lead isn't just a matter of pride, it's a critical advantage that makes TSMC the go-to partner for the most demanding and high-profile clients in the industry. This near monopoly on advanced chip manufacturing gives TSMC enormous pricing power and financial strength. The company has posted consistent revenue growth year after year, even during global economic slowdowns. Its profitability is the envy of the industry, and it regularly returns value to shareholders through dividends and share buybacks. TSMC's financial stability is underpinned by long-term contracts with the world's largest tech firms, making it a cornerstone of the global technology supply chain. But with great importance comes great risk. TSMC's headquarters and most of its manufacturing capacity are located in Taiwan, a region that sits at the center of rising geopolitical tensions between China and the United States. Any disruption, whether from conflict, trade disputes, or natural disasters, could have ripple effects across the entire global economy. The world's dependence on TSMC has even been called a choke point for modern technology. Recognizing these risks, TSMC is taking major steps to diversify its manufacturing footprint. The company is investing billions to build new fabrication plants, or fabs, in the United States, Japan, and Germany. These new facilities will help reduce geographic concentration and ensure that TSMC can continue to supply its customers even in the face of regional disruptions. It's a massive undertaking, but one that's essential for the stability of the global tech ecosystem. Some experts refer to TSMC's unique position as the world's silicon shield. Because so many countries and companies depend on TSMC's chips, there's a strong incentive for global powers to avoid any conflict that could disrupt its operations. In a way, TSMC's importance to the world economy acts as a form of protection, making large-scale disruption less likely, though not impossible. The demand for TSMC's chips is only growing. The explosion of artificial intelligence, the rollout of 5G networks, the rise of electric vehicles, and the proliferation of smart devices all require ever more powerful and efficient chips. TSMC is at the heart of these trends, enabling the next generation of technology that will define how we live, work, and communicate. Investing in TSMC isn't just about betting on one company. It's about investing in the entire future of technology. TSMC's chips are found in products from dozens of companies, spanning smartphones, cloud computing, gaming, automotive, and more. As long as the world continues to demand smarter, faster, and more connected devices, TSMC will remain at the center of the action. For investors looking to build a resilient, future-focused portfolio, TSMC is a must-consider stock. Its dominance, innovation, and critical role in the global economy make it a unique and compelling opportunity for long-term growth. Finally, we have Nvidia, ticker NVDA, the architect behind the AI revolution. Nvidia has been at the forefront of technological advancements, pushing the boundaries of what is possible in the world of artificial intelligence. Founded in 1993 by Jensen Huang, Chris Malachowski, and Curtis Preem, Nvidia started as a company focused on graphics processing units, GPUs, for gaming. However, over the years, it has transformed into a powerhouse in the AI industry, driving innovation and setting new standards. Nvidia's GPUs, once built for gaming, now power the world's most advanced AI models and data centers. These GPUs are the backbone of modern AI, enabling complex computations and deep learning algorithms that were previously unimaginable. From high-end gaming PCs to massive data centers, Nvidia's technology is ubiquitous. Their GPUs are not just about raw power, they are about efficiency and scalability, making them ideal for a wide range of applications, from gaming to scientific research to autonomous vehicles. Their 𝗗𝗜𝗦 software platform is a massive moat, with millions of developers and a vast ecosystem built around it. 𝗗𝗜𝗦, which stands for Compute Unified Device Architecture, allows developers to leverage the power of Nvidia GPUs for general-purpose computing. This platform has become a cornerstone for AI development, providing tools and libraries that simplify the process of building and deploying AI models. The extensive ecosystem around 𝗗𝗜𝗦 includes a wide range of applications, from machine learning frameworks to scientific simulations, making it an indispensable tool for developers worldwide. Nvidia dominates the AI chip market, with over 95% share in AI data centers, and demand is outpacing supply. This dominance is not just a result of their superior technology, but also their strategic partnerships and investments in research and development. Nvidia's AI chips are designed to handle the most demanding workloads, providing unparalleled performance and efficiency. As AI continues to grow, the demand for Nvidia's chips is expected to increase, further solidifying their position as the market leader. Their growth is staggering, revenue and profits have soared as AI adoption explodes. Nvidia's financial performance has been nothing short of spectacular, with consistent revenue growth and increasing profitability. This growth is driven by the widespread adoption of AI across various industries, from healthcare to finance to entertainment. Nvidia's ability to innovate and stay ahead of the competition has been a key factor in their success, attracting investors and driving up their stock price. Beyond chips, Nvidia is building full-stack solutions, from AI supercomputers to the Omniverse platform for digital twins and industrial simulation. The Omniverse platform is a revolutionary tool that allows developers to create and simulate virtual worlds with incredible detail and accuracy. This platform is being used in a variety of industries, from manufacturing to entertainment, to create digital twins of real-world objects and environments. Nvidia's AI supercomputers, on the other hand, are designed to handle the most complex AI workloads, providing researchers and developers with the computational power they need to push the boundaries of AI. Risks include high valuation and rising competition from AMD and custom chips by cloud giants, but Nvidia's lead is substantial. While Nvidia is currently the market leader, they face significant competition from other tech giants like AMD and Intel, as well as custom AI chips developed by companies like Google and Amazon. These competitors are investing heavily in AI and could potentially erode Nvidia's market share. However, Nvidia's technological lead and strong ecosystem provide a significant competitive advantage, making it difficult for competitors to catch up. Even with some market share loss, the overall AI market is growing so fast that Nvidia's future remains bright. The AI market is expected to continue growing at an exponential rate, driven by advancements in technology and increasing adoption across various industries. This growth presents a significant opportunity for Nvidia, even if they lose some market share to competitors. The sheer size of the AI market means that there is plenty of room for multiple players, and Nvidia is well positioned to capitalize on this growth. For investors betting on AI as a transformative force, Nvidia is the core infrastructure play. Nvidia's technology is at the heart of the AI revolution, providing the computational power and tools needed to drive innovation. For investors looking to capitalize on the growth of AI, Nvidia represents a compelling investment opportunity. Their strong market position, technological leadership, and consistent financial performance make them a key player in the AI space. It's a high-risk, high-reward stock for the next decade. Investing in Nvidia comes with its risks, including high valuation and potential competition. However, the potential rewards are significant, given the rapid growth of the AI market and Nvidia's strong position within it. For those willing to take on the risk, Nvidia offers the potential for substantial returns, making it an attractive option for long-term investors. There you have it, 4 tech titans shaping the future: Broadcom, Meta, TSM, and Nvidia. Each offers unique opportunities and risks, but all are positioned at the heart of major tech trends. Want to learn how to find great stocks? Check out the Value Stocks Investing Master Course. Link in the description. For exclusive analysis and real-time alerts, join the StocksGalore Patreon community. Which of these 4 do you think has the most long-term potential? Let me know in the comments. Don't forget to like, subscribe, and turn on notifications for more investing insights. Thanks for watching. See you in the next one.